It's Friday, and as usual, time to put on our strategic thinking caps and taking a look today at how Chris Hart, Chief Strategist at Investment Solutions, is approaching the market. Thanks so much, Chris, for joining us today. Well, yo-yo trade is what market activity has been labelled as, and amidst that, we've got many opting to go the defensive route more than anything else. Your approach to the markets right now?
No, it's actually very difficult because if you look at your two defensive assets, your two major defensive assets being bonds and cash, both are expensive. And when we say expensive, cash has virtually zero yield, and this is in a global context. Our own interest rates at very low levels, and bonds, doesn't matter how you slice and dice it, how you try and put the data through the ringer. Bonds certainly internationally are expensive. Locally, it's I suppose there is more doubt with yields at least at around about the 8% level, but your assets which have more yield, your bonds and shares, your so-called risky assets, look cheaper than your defensive assets. As a strategy, one would say if you're looking at valuation, one should be sitting overweight equities and underweight your defensive assets.
So possibly we've got to be a little bit more clear here in that defensive strategy within the equity asset class.
Yeah, so within the equity asset, you'd also be taking a reasonably defensive approach. And the reason is that your macro events are so dominant. And the sovereign solvency is quite a critical issue. Greece has not been solved. All the problem has been postponed. Portugal, the problem is postponed. Ireland, it's postponed. There's other problems coming onto the radar screen, including Italy. Now, we know if there's really strong alignment amongst the people who are going to pay and put the resources up, they can actually rescue Spain. But that's going to be a huge stretch. Italy is out of the question. Okay, utterly out of the question. And it just looks like these things are coming to the fore, which means that you'd still want defensive assets. The only trouble is with this sovereign solvency problem, etc., your defensive assets are starting to look as though they're the actual epicenter of risk. So what do you do when the system itself is not holding?
What do you do, Chris? Let's take a look at hard assets.
You
gold.
Then have to look at hard assets. So in other words, within the system, you should be overweight equities relative to bonds. But if the systemic risks are such that you can't, then you have to be buying gold, or farmland, or some hard assets. Gold is not the only opportunity in town, but from a financial management and portfolio point of view, it's one of the ones that are more easily accessible. And so you have to at least put some portion of your portfolio in gold as a hedge against systemic risks. Because when we look at the nature of various crises, there's always an opportunity. Can you remember the currency crisis here in 1998? Bonds did very badly, interest rates went to 25.5%, property was taken out, but rand hedge shares, you made a killing on rand hedge shares. And likewise the 2008 financial crisis, equities did badly, but bonds did very well. When a country goes bankrupt, there isn't a single asset class in there that protects you. Shares, bonds, equity, property, they all do badly. The currency does badly, as we saw in Iceland. In Greece, it's affecting the euro, but the euro is at 140, and the reason is that the dollar is also toxic waste. So on your hard currency call, right, of dollars, pounds, yen, euro, we call them the ugly sisters and all the rest of it. They really are hideous. And that's your hard currency core around which the global financial system is supposed to be run. Okay, and if all things being equal, you had the problems in Europe that we're seeing, that's very visible. The dollar and euro should be at least at parity, if not stronger. But there's serious systemic problems faced in the US as well. And that's why it's sitting at 140.
Yeah. Within that scenario, what's your view on the rand specifically? Because we've also seen it hold on to its resilience. It's been strong, and commentary is that we're looking at a rand that is overvalued at this stage.
It's overvalued, but there are three things that are gold, if you like, in the investment term. We offer yield, we offer growth, and we offer sovereign solvency with a debt to GDP ratio in the 35% region. US is over 90%. Even the solid German core is, close to 70% debt to GDP ratio. And the hidden liabilities, what I call the actuarial deficit, the debts that will be there if they meet their promises. They'll never meet their promises in pensions and social security, etc. You're looking, Greece is about 800% of GDP. US is about 600% of GDP. These are unaffordable. South Africa has a fully funded government employees pension fund, which means that our debt to GDP ratio of 35%, right, if you take those actuarial liabilities, is still 35%. And that says that the solvency is in fact incredible, right? And that's why South Africa will continue to attract investment. And the rand is arguably, and I say arguably because there's other measures that could say maybe it's not so overvalued, but certainly arguably overvalued is going to get even more overvalued.
And that within a context where we've got this debate raging on whether we should be vying more so for offshore exposure as opposed to local exposure.
Well, this is the whole thing, is that our market looks expensive as is, but with yield growth and sovereign solvency sort of on our side, is it that expensive? Or is it a place that people are parking money? And they are. And we saw this in the last month. The rand did very little, but we saw that the central bank stepped in and bought an additional amount of reserves to keep it relatively stable. If they weren't there, we'd be stronger on that rand. The flows are there.
And we can extrapolate that further within the cyclical sectors of our economy as well. So let's take it to retailers where, there's been a lot of commentary that we're looking at an overvalued sector, but rates lower for longer possibly. It's
exactly that, because if the rand is going to continue to strengthen, or at least hold its strength here, right, we do have a two-speed inflation, right? One for administered prices and one for, merchandise and that kind of thing. But the strength of the rand will keep inflation lower also for longer. And that means interest rates lower for longer. And that means the last dance is not there for our retailers yet. But one would watch the rand. If the rand starts to weaken, then inflation is going to be shooting to the sky. And that part is over for retailers. But while the rand strengthens, those retailers still might have some juice in them.